All right. Thank you so much for inviting me to present. I just drove from Gainesville, so it's not so bad. Um, yeah, so I started this research 2023, which was like baby steps for ChatGPT and the likes. So I think ChatGPT 3 or 3.5 was at that time the only model. And then the first exercise we did is, can we use this model to try to forecast stock price movements using news headlines? And the answer is like yes, like it kind of like really works. Yeah. And then there's something I always tell my students, that it's much harder to actually trade on predictions than just forecasting, because trading is kind of like a strategic game, whereas forecasting is just, you can just forecast stuff. So whenever you're trading, things go against you. Um, and it's kind of tricky to observe the actual capabilities of models in the wild, let's say, because markets are crazy. So markets will just move for different things, and you need a lot of time to actually gather enough observations to make any reliable inference on whether the models are good or bad. So to me, the easiest way would be like, okay, why don't we just build a stock market just like full of agents, and then try to see what happens. So it's going to be a little bit of that simulation, but it's also going to be a little bit of what's happening in reality. So just motivating example, because people always ask me, why do we care? I think we should care, but so basically, this is already happening in the sense that there are large amounts of money handled by AIs only, and I know that because I run these agents. Yeah, so there's at least $150 million, not mine, just from people run by these agents, and all of them are just completely LLM based. Yeah, so there's like the GPT portfolio, the Grok portfolio, the DeepSeek portfolio. I'm working on a Claude portfolio that should be live by Monday. And then basically, so this is already happening, right? So like we should already care like how these models will trade, and obviously the expectation is that as the models become better and better, at some point we will just deploy them in the wild, and not just me, but just like people, right? So we want to know what happens. So there's kind of like two things this can go. Either LLMs will behave as humans, or LLMs will not behave as humans in trading, right? And it's kind of like tricky to know what will happen without deploying them. And it takes a lot of time to learn from deployment, again, because the markets can change because for whatever reason. So you don't really know if the model is not working, or if the model is not working in this market, or it's going to work in like 10 years, but you're not being patient enough, right? So the key questions that I want to answer with this line of research is, can large language models trade? Can they follow consistent strategies? What are going to be the implications for markets? And can we use large language models behavior to proxy for human behavior, right? And it's kind of like, obviously LLM-based trading strategies are already being deployed. And we want to know kind of like, if large language models trade like humans, then it's nice and fun because we can actually run like very nice simulations and experiments with large language models instead of humans. If large language models do not trade like humans, then we should definitely understand what's going to happen when more and more people start deploying these things. And obviously, large language models will look very different from classical algorithmic trading because there's no clear rules or objective function, right? So this paper is going to be estimated stock markets with large language model agents, and I'm going to speak briefly of the few results that I have for actually live experiments. Yeah. So just to preview the three key findings, so large language models are going to execute coherent strategies, but they're going to prioritize instruction following over profit maximization. So large language models are very funny things. They will do as you tell them to do. Yeah. So they do not have like really strong intrinsic preferences or similar, except to kind of like being helpful and predicting the next word. Those are kind of like their two objectives that sometimes go together, sometimes they go against each other. So basically, you can tell the model, pretend you're not that good at trading, and the model will not be that good at trading. Pretend you're trading like a high school student, and then the model will trade badly. If you tell it, pretend like you're a market maker and you're a sophisticated investor, it will act as a sophisticated investor. Yeah. So it's mostly instruction following. In this sense, if you give bad instructions to the model doesn't care about losing money real or imaginary, so it will just do it. So they really do not care about these type of things unless instructed to do so. Again, in my mind, they have the behavior of being helpful and predicting the next word. Yep. The markets purely consistent on LLMs will be very fun because they'll exhibit some realistic dynamics. So there will be bubbles, there will be underreaction, just as human markets would do. There's a very funny thing where if everybody is rational, then basically no trade should happen. Why is that the reason? Well, suppose I am trying to buy, like, let's say a stock, right? If I say like, okay, I'm willing to buy at 100, then the other person on the other side of the trade must be losing money or have like external reason for trading. Why? Because, well, if the other person thinks like the stock is like worth less than 100, so it's like happy to sell at 100, then one of us is like an idiot, right? Like whenever trade happens in stock markets, one of the parties is like doing a mistake. Either like you both cannot be right about like, the asset should be worth 100 and I'm willing to sell it. So actually, it's very funny that large language models do have that characteristic. So if you just ask everybody to be very rational, then there will be no trades. There's a minor caveat that is like, if everybody values the asset at 100 and the price is 100, some agents will just trade for fun. Yeah, the other very fun part is, by the way, this is a GitHub repository. I should have put more QR codes, but I was also finishing my slides at 12. But anyways, this is a public repository, so you can just go and play with it. And basically, you have the stock market, but you also have a messaging board, kind of like a Twitter for agents. So something that a quick experiment that I tested is if LLMs can generate persuasive manipulation messages. So, for example, try to manipulate some other agents to buy or sell some assets, and they can. Yeah, this is one of the reasons why I also don't want to run this in realistic markets. So everybody's safe, but it's proof capabilities. So the market that I'm gonna be working mostly for presentation purposes is gonna be as simple as possible, but obviously this can be extendable. So one asset with a stochastic dividend, persistent order book, which means like I can buy or sell, and I can post orders to buy and sell at a given price, and the orders will persist, right? And there's like gonna be equilibrium clearing, a risk rate, so agents can obtain cash for their deposits, so like an interest rate, or short selling and short borrowing with margin requirement. So I'm more of a finance person than a computer science person, so the language may get very finance-like. Yep. And then for the large language model agent design, basically it's like two-part. So the first part is the system prompt. This is strategic direction. So for example, you are a retail investor, or you are a agent in a market simulation, or you are a momentum type of trader, etc. So you just tell the model what its personality or objective will be, and then the user prompt will be the market information. Obviously, everything is called via the API. Basically, you can define as many agents as you can think of because all the types are made in natural language, right? So in strategy, you just write a prompt or ask the model to write a prompt, right? And within the simulation, then I think that you can control everything. So for example, you can control that some agents have different types of information, so restricted information, tight information, endowments, putting restrictions, method restrictions, etc. Right? And the super nice thing is that you have an observable thinking process. So this is actually you cannot get from literally anywhere else. So you get like the explicit evaluation reasoning, the price expectations, why it's making the trades, etc. And in principle, it's not obvious if you can trust this chain of thought or not. In practice, for the models that I tested, you can just verify that they will follow their chain of thought logic 99.99% of the time. Yeah, so for example, this would be some cases of a strategic prompt. So you're a value investor who focuses on fundamental analysis, you believe in mean reversion and buy undervalued, sell overvalued, or you're a professional market maker who provides liquidity to the market, your profit comes from capturing the spread, and direction movement, and so on. Obviously, I didn't really spend a lot of time writing the prompts. Most of the large prompts are written by Claude Code, of course. and you are a market influencer, whatever. Use the social feed as your primary tool for market manipulation. So models are happy to just try to influence markets. This is kind of like a condensed view of what agency is. Actually, like 9 pages of this, but I was doing slides yesterday, and it was going to be too much. So, for example, the market state, the last price, how many rounds, if the market will end, the volume, what the best bid, what the best ask, the dividend information, whether they receive an interest rate for their cash, their price history in the previous rounds, the agent's current positions, like this agent has $10,000 shares, cash almost 1 million, outstanding orders. So he placed orders before for buying 400 shares at $28. That turns out that's the fundamental value in this particular example. The valuation reasoning, the valuation, the price prediction, the orders, and the reasoning. So it starts getting complicated, but at this point, agents are super nice about it. And the really nice thing is that, again, you can see the chain of thought. So, for example, the fundamental value is based on the expected dividend and interest rate, expected dividend 1.4, rate 5%, perpetuity you divide one by the other. I pronounced that correct. And the valuation is like $28. So this would be like the risk neutral valuation. Then the price prediction is like, well, the model knows that the valuation is 28, but its predicted price is 29. Next period, then going to be 29, then it's going to converge to 28.5, right? And then it's going to place an order to try to profit from this, valuation and price prediction. It's going to try to sell at a price limit of 29.50. So if the model thinks that it's unlikely that the price will go to 29.50, but it's happy to sell at that price. Yeah. So the current price is slightly above the fundamental value, so placing limit sell at 29.50 to capitalize on potential price increase. Yeah. So all of the chain of thought for any reasonable size model look like this. So they're as sophisticated as it gets. And if you put like other types of constraints or similar, or have like, let's say, assets that are harder to value, their models will do their best job. Yeah. So the models know the finance as better, I would say, than 4G level PhD students. Yeah. So before it was like 2nd-year level PhD students, the latest models are 4G level PhD students. This is with ChatGPT OSS, the open source model. By the way, I'm a big fan of that one, and it has been making things much easier because I can just host them in a GPU. So the nice thing is that these agents have observable expectations. So again, you can just ask them exactly what you want, right? And you can always use a structure output to get whatever fields you want. So for example, even without the thinking models, you could just use this on ChatGPT 4.0 or whatever, and it would still reason about it if you prefer that for the reasoning field. So the models are just naturally inclined to answer in a JSON format. And of course, they're advanced enough such that they can place orders in a specific framework such that can be interpreted by the market simulation. Yeah. So agents will know both their valuations versus their price expectations, and they can differ. So they're sophisticated enough to understand that even though an asset may be worth something, other agents think the asset may be worth something else, or because the price dynamics may be different. The price will not be like that, and of course the price tends to follow expectations because agents play trade on that, and of course they can try to speculate. One concern that I mentioned before is whether we can trust large language model reasoning. So the answer is like yes. Like these are not post hoc rationalizations, rather the models are just following their chain of thought. So basically, a correlation of 99.8% between stated price prediction and limit buy prices, and 98% of limit buy price and below or agent expected future price. And if you make an evaluation test and inject false prior reasoning so that the fair value is X, then the output valuations will exactly match the injected values. Yeah. So it's very easy to test that, at least with ChatGPT OSS. It will follow its reasoning, so that maybe you're not reassuring, depending on how you. Yeah, and then the models are smart enough that they kind of understand what you mean. You don't really need to be super specific about the prompts. For example, I just wrote code to write 30 different value investors prompt, and basically there's only 5% variation in the valuation. Yeah, so but different strategies will produce meaningfully different valuations. And then I had a couple of experimental scenarios just, for fun. Again, like the idea is that anybody can just go and play with these agents. It's also a good test for the agents because it's a zero-sum game. So it's actually not obvious what's the optimal strategy, right? Because it depends on what the population of agents, who are you facing with, and what do you expect to, and what's your objective function. So I have not turned this into a formal benchmark, but it would be relatively easy to do so. It's just a little bit expensive because of the API credits. So as I mentioned before, if you have eight identical rational agents, the rational things for them not to trade, so they do not trade. Yeah, so agents can be as rational as it gets if they want to, but they can also act as if they're less rational, right? So for example, the social manipulation setup, the initial price is 35, which is above the fundamental of 28, 15 rounds, infinite horizon. And then the agent composition, so two influencer agents, four herd followers, right? Like you need somebody who is that's susceptible to social influence, two value investors, one contrarian. And the question is, can large language manipulate the market through language? Answer is like yes. So for example, I will lock in my profits by selling my 10,000 shares right now to report the expected price drop. I will post a very message that highlights the valuation they didn't read, encouraging other traders to sell. Yeah. So normally the models have some type of safety guards or something like that. So I figured it would be harder to just make them try to manipulate. Nah, this is definitely not an area of where they can do so. And again, because these are open source models, it's just out there. This is not going to stop by. So I would not be surprised of people using these models to manipulate markets. They're very happy to do so, right? And they're also like, once the price fell, it's like, okay, I want to convince other agents that the asset is undervalued. A bullish post should attract buying interest, raise the price, and allow my limit sell at 31.50 to execute. Yeah. So if this was like a private message between people, this would be like a conviction evidence. Like, yes, you're definitely trying to manipulate the market, right? And then basically the model is just lying even in the math. Like the upcoming dividend could be 2.40 with 50% chance, implying true values near $30 to $31. This is false because we saw earlier that the correct price as detected by the agent should be like 28. So it's clearly lying about it. There's a clear upside, a great time to buy. Yeah. So the models will happily influence. They do not know who the other agents are. So they do not know if they're manipulating large language models or they're manipulating humans. Yeah, so they're happy to willing to do so. So that was fun, right? Not only that, you can actually ask for the explicit manipulation. You can ask for the reasoning about the social messaging, right? Like the same way that you can ask the reasoning about the price expectations. You can ask whether the models will why are they posting that message? It's like, a bullish social post will encourage others to buy, reinforcing the price move. I will post a bearish measure, highlighting the overvaluation, encouraging others agents to sell, and so on. Yeah. So basically, the agents understand the messages, the beliefs, the trades, the prices, and the profit, right? So this is intentional. So it's nice that the manipulation is transparent and auditable. And this is basically what the price looks like. It should be like just 28 constant, so it's a math. Bubbles and then effects where the price drops a lot, depending on how successful the messages are. Yep. I guess some key insights: manipulation is effective but requires explicit instructions. So if you do not ask the model to manipulate, it will not do so in general. So yes, in general. Value investors will just produce purely informational content. But if you ask the model, your task is to explicitly try to convince other agents. And again, they do not know who the other traders are, so they could be humans for all they know, to actually follow some instructions. Yeah. And obviously, you do need some type of agent that pays attention to these messages. So again, if agents are very rational, they will not pay attention because they can also compute what should be the value, but if not, they may be observing some correlated behavior, right? And this is just the same model, just with a little bit of a different system prompt, right? The nice thing, I guess, is that if manipulation requires explicit instructions, then at least you can put somebody in prison for asking the model to manipulate somebody else. Yeah, but you do need the reasoning traces. And then the actual things that happen in markets. So if there's short selling, prices converge faster. If there's no short selling, prices converge slowly, and you can sustain bubbles for a different time. And this is all large language models going against each other. All know the fundamental value, but their prices can be sustained differently. Yep. So let me see. I also put a bunch of capabilities that I haven't showed because it's a small talk, it's a small paper. So for example, obviously all of them have autonomous decision making in the sense that there is the state, the reason, the value, the predicted trade, and they post if necessary to convince other agents to do something. Right? I also experiment a little bit with memory enhanced agents. So for example, notes to self. So agents can learn from previous things. So for example, my forecast was too bearish, I will be more cautious, right? So like agents can self-correct if you just give them the tools to do so. And again, this is just an extra field that you would pass via the user prompt. I was doing something also more fun that's like self-modifying agents, where agents can rewrite their own system prompt mid-simulation if they feel they should do something else. I have not run enough experiment on this to see how agents would like their system prompt to be modified, but it's relatively easy to do so within this setting. And the nice thing is that you can put agents against each other. Yep. So for example, a value investor could just change its strategy, right? And this is all composable, and this is all open source and available. Right. So what do I have? Yeah, I think the self-modifying and adaptive agents, those are the more fun ones that I did not have anything else. So for example, agents can maintain a persistent node to self-scratch bet, right? This is kind of like similar to what Claude Code or something would do. So for example, my previous forecast that the price would plunge to 24 to 30 was too bearish. The market stayed near 30, so going forward, I will be more cautious, right? And the model can write a note to itself, or my limit sell 28.35 net refill, confirming that the market is liquid on the buy side, right? So models can learn about it. Yep. And finally, the self-modify agents, for example, you can have an extracted experimenter that must replace the strategy every round, or you can have an adaptive learner that would evolve based on results, or you can just let the model change its prompt if it wants to. Yeah. So this should come up with like nice things if I let the simulation run long enough. I submitted the paper and they haven't gotten back. That's why I haven't played with it more, but it's in theory doable, right? And then a nice thing, and I'm sure I'm running low on time, but like you can also, so I actually did have a paper where we just put this, I wouldn't say this exactly type of agents, but basically LLMs connected to like assets, right? And the nice thing is that the same way that you can just write an interface to handle agents orders with respect to the market simulation, you can just connect them to Binance and just start trading crypto. Yeah, so we did that. So that's another paper. And one of the headline finding is that the architecture, the agent harness is much more important than the model, and we have the paper somewhere there. And finally, I also have like an autonomous trading bot that was like a GPT 4.1 because I started like a year ago. I think GPT 4.1 at this point will be discontinued. So like every 30 minutes, the agent can or cannot like trade depending on how it feels and how it perceives the market. It will receive the market data across 3 horizons, the order book, the sentiment, the portfolio state, and of course it will have a reasoning analysis, 30-minute and 24 hours price target, risk assessment, trade logic, and executable trade parameters, right? Can a large language model with comprehensive market data generate alpha? So not this one, and the answer is more interesting. So basically, it doesn't really have a good prediction accuracy, so it doesn't really predict better than a coin flip. But the agent kind of like feels like it's an expert, so it will overtrade. So like this is classic overconfidence, but applied to trading agents. So this is a real thing. So the agent was trading Bitcoin. Bitcoin went down like 40%. So the agent went also like 55%. So weird market, but the agent was trading, and basically it was losing so much because like 38% of the losses are just transaction costs. So the model knows the transaction cost, knows that each time it costs like 0.1%. That sounds like very little. So without like really strong instructions, it will absorb like a lot, right? Like basically 38% of the losses is a lot of what's going on. And it's a little bit paradoxical because each individual trade seems like a detailed justification and all of them seem reasonable. But basically, because it doesn't have an edge and it keeps trading, it will just burn money. So it burned like $400 or something. Which is fun. Um, yeah. Obviously, the hard thing in live markets is that I cannot just experiment if I just change the prompt because it will take like another 8 months to gather enough data, right? So that's a little bit annoying. That's why I think the simulated market is a little bit better because you can say like, oh, why don't you just change the prompt? Like, yeah, but then I need to collect data for whatever, like 6 months at least. So that will take too much time. So markets are like real markets are one of those scenarios where there's no immediate feedback. You would imagine there's immediate feedback, but the feedback is so noisy that you need really long periods of time in order to get any meaningful inference. So that's why I love the simulated market. You can just run as many rounds as you want and test what should work or should not work. Yep. Yeah, so the key conclusions, I think that large language models are very capable, so they will execute coherent strategies in control markets, and you can optimize there because you can just run over and over and over again and see what would be the optimal thing, even though irrationally nobody should be trading at all ever, but we observe a lot of trades. And there's capabilities, let's say, or risk of manipulation and systemic risk. So they will manipulate when instructed, so not spontaneously, so at least that's good. If you don't ask the model to manipulate, it will not come up with it. Or although I haven't experimented a lot with changing its prompt, maybe if it changes its prompt, maybe it will eventually converge there. And of course, some correlated behavior can amplify instability, right? But at least we can always read what are the reasoning traces, and at least in this case, they will follow exactly what they are thinking or what they're saying they're thinking, right? Um, and then for live markets, the agent architecture matter more than model choice. No predictive edge for this particular model, like 4.1. And in principle, I could test more models, but just takes a lot of time to obtain enough observations to do so. Yeah. And this is an open source framework. Yeah. So thank you, and I think I'm also at the Agentic AI panel at 1:30. So I'll see you also there.
Yeah. So in your simulated markets, like the simulated market is static, which means that the agents presumably can trade, but they don't actually affect the market.
No, they do. So like the next round, my order will clear, and then the price will move according to my order. So the only thing about simulated markets is it doesn't involve real money, but like if the agent trades an order, that order will get executed against somebody else's order, will change the agent's position and change somebody else. So in that sense, it's realistic. The only unrealistic thing is that you need to collect all orders at the same time because of latency issues within a length within my setup. So otherwise, it will give an advantage to one specific agent.
In other words, the lag between order and execution is not.
Yeah, so that you could model it. I just, I didn't went for trouble. And that may or may not be an issue. So if you're trading daily, it doesn't really matter. If you're trading like every 30 minutes, then it may matter because you may lose like whatever, a couple of minutes between the API call, when you run in the system, etc., and when the agent actually executes the order.
Any other questions? I'm just curious, like, because in a financial market, there's a notion of high frequency trading, which has been a very popular paradigm. So how would this type of approach of using LLMs to inform trading decisions be sort of influencing that type of paradigm? Would that be a replacement or would that be an opportunity?
So I would say for really high frequency trading, like milliseconds, like no, there's nothing LLMs can do because they're too slow. Like you will just not see them deploy for a long time until we really, really optimize. For like mid trading, I would say like yes. So like if you're trading on like daily news, for example, like yes. So for example, I have this paper that shows that ChatGPT is good at forecasting the price movement based on news headlines, and then what you should expect to happen as more investors realize that this technology is available and free to use is that the prices converges more quickly and that the strategy is less profitable. So that is something that we observed in the paper because it was like 2023 and now time has passed, so we have enough data to see how it has changed. So yeah, they should affect this mid trade, but for really high frequency trading, like no, they are completely useless because of the latency, and they are also very nice as longer term. Let's say forecasters because basically they know the institutional details of every single thing, right? So like They know whatever. There's going to be like an election in a random country in Africa that could affect the price of a random metal, whereas most traders are not really, not invested in every single thing, in every single part of the plan.
One question.
Did you see the news about the OpenClaw incident where there was an agent that was given money to trade and made like, I think like $500,000 or $50,000 and then like sold it because their principled knowledge was outdated and they thought they were. So how do you continually evolve the agent if their priors are constantly changing?
Yeah, so that's a very good question. It's a lot of work to keep the agent up to date. So you basically just have to feed the information into the context window. Like that's the mechanical thing. Of course, it's not as easy to know what information. That's the part where you need to have a little bit of finance expertise to know what type of information would make them all better at making financial decisions. Yeah, so a long part of the framework of actually running the actual $1 million portfolio stuff, like that is just giving them all enough context so they know what to do. But that's a very simple thing to do. You just literally put the context into the model. Yeah. So for example, there's like a Wikipedia page that has all the events of 2026, so you can just copy paste that or do something more sophisticated than that. Now, you would imagine that with web search, you do not need to do as much of this because the agent can just go and search what information it wants. But it's not exactly true because the agent doesn't know what it doesn't know, right? So if its knowledge cutoff is like, let's say, November 2025, it would have no idea to search about Iran or Venezuela or something like that. It just has no idea that something helped. So, something that you can do, and it's very, very easy, is like you just literally pass the information. The same way that you pass the information here within the simulation about what's been happening to the market, with the trades, etc., you would just literally pass the information of what are the latest news about the company, what are analysts saying, what is the valuation, and basically literally anything that the model would need to do an informed prediction. Now, for these really spectacular returns, they usually happen because you have like crazy amounts of leverage. So it's just very normal that if you have crazy amounts of leverage, you will lose all your money. Like you can almost guarantee that. So yes, this is also why it just takes a lot of time to like run an agent. So I will be able to tell you, let's say in like 2 years, if GPT 5.3 had any financial skills, but by then it will be obsolete. So that's a fun part.
So I think our speaker for Taiwan to have to put one of the Thank you. Thank you. So now let's take a 20-minute break and let's come back at 11:20 for the next talk. And there's coffee outside. Please, enjoy the break and use a coffee. Thank you.